let's just dive right into this explainer, because today we're unpacking a massive global financial engine that literally started out, well, under a tree. We hear about the stock market constantly, right? The Dow's up, the S&P's down. But how often do we actually stop and ask how this $25 trillion ecosystem truly works? Well, to understand the giant, we got to look at the seed.
And the origins? Surprisingly humble. Back in 1792, just 24 brokers and merchants met up under a buttonwood tree on Wall Street. Their entire goal was just to set a flat 0.25% commission rate and agree to only trade securities among themselves. That's it. No fiber optic internet, no flashing digital screens, just a handshake agreement to build a trusted, exclusive marketplace.
So how did we get from a literal tree to the modern market? Well, in 1790, the U.S. refinanced its debt, issuing $80 million in bonds, which were basically the first publicly traded securities. Then we get our 1792 Buttonwood Agreement. By 1817, this little group formally becomes the New York Stock and Exchange Board, setting up rules to curb manipulation. Skip to 1867, the stock ticker drops, and suddenly prices are beaming far beyond Wall Street. Fast forward, and that tiny group evolved into the New York Stock Exchange, which now oversees tens of trillions in daily trading. Absolutely wild.
All right, here's our roadmap for this explainer. 1. Meet the stock market. 2. Primary versus secondary. 3. Executing your trade. 4. The forces of price. And 5. Bulls, bears, and rates.
Starting with Section 1. Meet the stock market. Let's lay the foundation at the micro level. What exactly are we buying and selling? A stock, or a share, is just a unit of ownership in a company. It gives you, the holder, a literal claim on part of that corporation's assets, their earnings, and even their voting rights. The crucial takeaway here is that you aren't just betting on some random three-letter ticker symbol blinking on a screen. You're buying a piece of a real-world, breathing business. You own a microscopic slice of their factories, their patents, their future profits. You might even get a say in how the whole shebang is running.
Moving on to Section 2, Primary versus Secondary Markets.
Okay, so we know what a share is, but where do they actually come from? There is a really vital distinction here between where shares originate and where they end up being traded. In the primary market, companies sell brand new shares directly to the public to raise funds. You've probably heard this called an initial public offering or an IPO. Think of this like buying a brand new car straight from the factory. Your money goes directly to the company so they can build new plants or hire more engineers. But the secondary market? That's where investors trade existing shares with each other on exchanges like the NYSE or the NASDAQ. It's basically like buying a used car from another driver.
And here's the real kicker. In that secondary market, trading happens solely between investors. The issuing company's actual bank account not impacted at all. So those wild daily price swings you see on the news, that's all secondary market action. If a stock drops $10 in a single day, the company doesn't suddenly lose that money from its own coffers. It just means the perceived value among investors has changed. The company, they already got their cash back during the primary market IPO.
All right, Section 3, Executing your trade.
So we know where they're traded, but how do you actually buy one? Sadly, you don't just furiously yell "buy" into a telephone anymore like in the movies. Today, you essentially have 3 distinct tools or order types. First up, the market order. This is all about speed. You're telling your broker, hey, buy or sell this immediately at whatever the best current price is. Second, we have the limit order. This one's about control. You specify the exact price you're willing to pay, and the trade only happens if the market hits that price or better. And finally, the stop-loss order. Think of this as your defensive shield. It automatically triggers a sell order if your stock drops to a specific price, capping your potential losses. So, you can choose to prioritize speed, or you can strictly control your limits to manage that risk.
Which brings us to Section 4, the forces of price.
So once your trade is out in the ether, what actually makes the price of a share move? I mean, why is the stock $50 today and $55 tomorrow? Honestly, it just boils down to the oldest rule in the book, supply and demand. Prices rise when demand goes up, right? Eager buyers are competing for a limited number of shares. And what drives that? Usually things like crushing an earnings report, some really positive industry news, or upgraded analyst forecasts. But on the flip side, prices fall when supply increases, when fearful sellers are all rushing for the exit at once. That's usually triggered by disappointing earnings, sudden regulatory fears, or just general market panic. It's essentially a massive, real-time, global tug-of-war. But that leads us to a pretty fascinating question. If supply and demand control the price of individual stocks, what on earth controls overall supply and demand?
Let's zoom out from the individual companies for a second and look at how massive macroeconomic forces shape these behaviors on a global scale.
Section 5. Bulls, Bears, and Rates.
Look, the overall mood of the economy heavily dictates whether investors are feeling optimistic or terrified. You've definitely heard the terms bull market and bear market thrown around. A bull market is that golden period of rising prices, widespread optimism, and surging demand for stocks. It's like this great recursive cycle of confidence. But a bear market, that actually has a very strict definition. It's specifically a 20% downturn from recent highs, fueled by pessimism and uncertainty, where investors just sell off everything to avoid risk.
But hey, here's a little perspective that might ease your mind. Historically speaking, going all the way back to 1872, the median bear market lasts about 19 months, but the median bull market? 42 months. This perfectly illustrates how bull markets last more than twice as long as the bears. The long-term upward trends heavily outweigh those short-term downward corrections.
And honestly, the numbers get even better. 87%. That is the median price spike during a typical bull market. So prices historically rise more than double what they fall during a standard 33% bear market drop. So yeah, bear markets are absolutely scary when you're in them, but historically they're just temporary setbacks within a much larger upward trajectory.
Now, let's talk about the absolute ultimate macro force. What actually happens when the Federal Reserve steps in and messes with interest rates? Because beyond just market sentiment, this is the single biggest lever that directly impacts both corporate profits and your personal wallet.
When the Fed raises rates, it essentially slams the brakes on the economy. First, borrowing costs jump for companies. If loans are suddenly way more expensive, businesses pause their expansion or freeze hiring, which obviously hurts future profits. Second, consumer demand tanks. Higher rates mean your credit card and mortgage payments go up, leaving way less cash for big purchases. And third, and this is a huge one for the stock market, treasury bonds start offering higher yields. Suddenly investors have this really safe, high-yield alternative to stocks. Naturally, that pulls a ton of money out of the stock market, which drives share prices down.
Because these massive macro forces, inflation, rate hikes, global events, are just totally unpredictable, truly successful investors don't even try to guess the future. Instead, they stick to a disciplined, long-term game plan. Step 1, take the emotion out of it. Literally, don't panic sell at the absolute bottom, and definitely don't buy in purely on hype. Step 2, use dollar cost averaging. Just invest a consistent amount on a regular schedule, completely ignoring what the market is doing that day. Step 3, diversify broadly across different asset classes like stocks and bonds, just to spread out that risk. And Step 4, rebalance periodically so your portfolio stays aligned with your actual goals.
Ultimately, yeah, rising rates and sudden bear markets are gonna cause some panic. But time and diversification, those are your absolute best friends. Market swings are gonna happen. It's practically guaranteed. But if you understand the actual mechanics we've dug into today, from that humble buttonwood tree all the way up to the mighty Federal Reserve, the real question you have to ask yourself is this: are you financially prepared to just ride out the cycles and let time do the heavy lifting for you? Thanks for hanging out with me for this explainer, and we'll catch you on the next one.